Peter Thiel, the co-founder of PayPal and one of the most prominent venture capitalists in the Silicon Valley, was one of the first to sound the alarm this week on the failure of Silicon Valley Bank. And as he withdrew all of his founders' funds capital, he also advised all of the companies in his portfolio to do the same. And this is likely what caused one of the biggest runs on an American bank since 2008. And specifically on the 16th biggest bank in the US. Now, that's not to say that Peter Thiel and his company had anything to do with the problems that were facing the Silicon Valley Bank. They didn't. However, their actions show just how fragile a bank that has all of its eggs in one basket can be. Because had Peter Thiel not noticed that there was a technical error when his company tried to move money from a capital raise from one account to another, then the Silicon Valley Bank may have just made it through their financial troubles. But when one of the most prominent figures in the Silicon Valley sounds the alarm on your company, you'd best believe it's the beginning of the end. And I'm going to discuss exactly how they got themselves into this mess and what it means for the general banking system in North America. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. Okay, so let's start by discussing who Silicon Valley Bank is, because aside from the fact that it is the 16th largest bank in the US, or at least it was, it's a little known bank to most consumers because it primarily does business with big tech startups. In fact, it accounts for 44% of the lending in the tech space in the US. And in addition to the lending in the US that they do, they also have a $400 million book in Canada, although they have an external bank license in Canada, which means that they can't take deposits from Canadian companies, they can only lend to them. And the reason why they've been lending so much money in Canada in the last couple of years is an indicator of what the problems were that led to the failure of Silicon Valley Bank. And I'll get to that in just a second. But here's the problem that Silicon Valley Bank faced. They had put all of their eggs into essentially one basket, and that was the tech sector. And as we all know, in 2020 and 2021, the tech sector globally was thriving. This meant that many tech startups became household names, and that the amount of money that these companies were making was significant. And when you have a bank that has as big of a market share as Silicon Valley Bank does, what that meant was an incredible amount of deposits. Because obviously all the companies that were doing really well were putting their money into their bank accounts, and in this case, a lot of them had those bank accounts at Silicon Valley Bank. Now, normally lots of deposits would not be a problem, but in the era of rising interest rates created a significant amount of problems, primarily because they had so much money in deposits that they didn't have enough clients to lend the money to. That's why in the last couple of years, they entered Canada and increased their lending book to tech startups from 200 to 400 million. Because Silicon Valley Bank's biggest problem was that they didn't have enough people, enough companies to lend the money that they had on hand to. And that's what started the unraveling. Now you might ask, well, if they had a ton of deposits on hand and not that much money lent out, well, wouldn't that create a scenario where they should be more than secure? Well, not really, because here's how banks make money. Banks take deposits and pay very low interest rates to the people who have deposited the money into their institutions. They then turn around and lend that money to borrowers, and the spread between the interest that they are paying their depositors and the interest that they are receiving from their borrowers represents their profits. Now, between 2017 and 2022, SVB's deposits increased from $44 billion to $189 billion. However, their loan book only grew from $23 billion to $66 billion. And as a result of the gap between the $189 billion of deposits that they had and the $66 billion loan book, they had to find something to do with the funds that weren't being lent out. Because shareholders would simply not be happy if they were to find that SVB had that significant amount of money on hand, but was doing nothing to earn an income from it. As a result, SVB made $128 billion worth of investments in different types of bonds. But wait, why would they turn to bonds to park their money? Well, the answer to that question is that bonds are typically a pretty safe investment. In fact, if you hold them until maturity, there's very little chance of losing money on them. And SVB had likely intended to hold all of the bonds they had invested in until they came up for maturity, or until such time as they could find a better return on their money. But I don't think they expected to find themselves in a situation where they would have massive amounts of withdrawals that would cause them to have to sell those bonds at a loss. And this is where higher interest rates came back to haunt them. Because as the Fed increased interest rates, the value of those bonds went down significantly. In fact, that $128 billion worth of bonds became only worth about $91 billion at the time that the bank went under. And the fact that the bank had to take a $1.8 billion loss from the sale of some of its bonds in order to cover withdrawals made headline news and ultimately led to a significant drop in the SVB share price. Now, as an aside here, if you're one of those people who took a variable rate mortgage and you're sitting there thinking, oh, I should have seen this all coming, well, the reality here is that even bankers, some of the most sophisticated in the world, were still investing in bonds in 2021. And those same sophisticated bankers, just like everybody else, didn't see the significant amount of interest rate hikes that were coming down the pipe. So when somebody tells you that the increases to interest rates that were coming were obvious, what happened with SVB is a prime example of why it wasn't. People are often really good at saying, I saw this coming, especially when it's in hindsight. But even some of the smartest minds in the world didn't forecast the significant interest rate increases, and this is a prime example of that. Now, as a result of those losses, SVB had to go out and try to find some money to cover them. And this is when everything unraveled, because many of SVB's depositors started to pull their money, including Peter Thiel and pretty much every company in his portfolio. And when somebody like Peter Thiel starts telling the CEOs that run the companies that he's invested in that they should be pulling their money, well, it doesn't take long for rumors to start and the rest of Silicon Valley to also realize that there's a significant problem here and to start doing the same. So in as little as a week, we saw SVB go out of business. Now, what does this mean for people who had deposits on hand with SVB? Well, any deposits up to $250,000 are federally insured, and anybody who had deposits in the bank up to $250,000 are going to get at least that portion of their money back. Now, for other people and organizations that had more than that, it's going to be a matter of time before they can figure out how much of their money will be returned to them. And this could have greater repercussions for the banking system as a whole, not only in the US, but also in places like Canada and around the world. Because Silicon Valley Bank wasn't the only bank who was affected by this. Another bank called Silvergate Capital Corp also went under this week, primarily because of their investments in cryptocurrency and the exact same issues that arose because of higher interest rates. And again, that was significant investments in bond portfolios that went down in value. And when people came coming for their money, they had to sell those investments at a loss, leading to losses within the bank, as well as concern from depositors that their money was in jeopardy. And there could be other banks that are in the exact same position. In fact, US Treasury Secretary Janet Yellen said this week that they are monitoring a few other banks in order to make sure that the same things that happened to SVB aren't happening with other banks as well. But this goes to show that when things get bad, how fragile banks can be. And if people in large numbers start to be concerned with the security of their banks, it could lead to future runs. And if the problem becomes big enough, it could be catastrophic not only to those banks, but also to the economy in general. Now on this channel, we often talk about the things that affect the economy most are the surprises that nobody expected, and this is certainly one of them. And the hope here is that we don't see further problems and this becoming a systemic issue for all banks in the US and potentially into Canada. But for the most part, most citizens are going to be covered from any losses if there is a run on the bank. Canadians are typically covered to up to $100,000 and Americans are covered up to $250,000. But even with federal insurance in place, this still is a scary story. But the good news is this seems to be a product of a bank being invested in a very small niche. And for the most part, most banks don't find themselves in that situation, especially when you look to the bigger banks, especially the Canadian banks that own a significant amount of the American banks now. So only time will tell how big this problem is. Obviously, back in 2008 with the collapse of Lehman Brothers, it seemed like this wasn't going to be a big issue, and as we found out more, the issue got bigger and bigger. Let's hope in this scenario that is not the case. And let's also hope that central banks are paying attention to this issue and monitoring it to make sure that they don't increase interest rates even further and create even more systemic issues for the banking industry and the economy as a whole. Oh, and if you want to see more videos like this one, make sure you check out the videos that are suggested right here.